Okay, dear student, this is Mustafa Mirchawala from Mirchawala's Hub of Accountancy, your FR trainer. And today we are going to discuss pre-mock June 25 question number 2, the last question, that is ratio analysis question. And as you all know, that ratio analysis is the mandatory part. Ratio analysis is the mandatory part of your FR exam. Okay. And I would say it's a scoring area. You will see this question, majority things are ready made, majority things are scoring like it came before as well. I must say that nowadays examiner repeat question as well. So if you have good grip in your past papers, if you have done like last 5 to 6 attempt past paper question, you can perform very good in the exam. Okay, plus you are, if you are confident. Okay, so once again, you can see on the screen the recent results. You can see the marks 90, 87, many students scored in 70s, 80s. So you can also do it. They also followed the same pattern. Okay, so this is your question. The name of the question is Magnolia Group. Now, Magnolia Group operates in the fashion and accessories industry. On 1st of January X7, keep this date in your mind. Keep this date in your mind. Magnolia Company disposed of one of its subsidiaries. So this is the question of disposal as well. Hope you remember the disposal, the how to break the building of consolidation. Okay, on 1st January, that means the first day. That means the first day of your accounting period. First day of your accounting period. Okay, so they are saying they sold this subsidiary Pearl for cash of 52 million. So this is one important event. That on the very first day of 2007 they received this much big 52 million dollars cash. Okay, so we need to fix this cash as well. We need to see where did they use this cash. This will be the part of our commentary. Now, Pearl Company manufactures home decor items. This is the subsidiary which we just sold, used to make this home decor items. Okay, and was sold because the Magnolia Group decided to focus on fashion and accessories sectors. Now they are purely focusing on fashion and accessories, so no more home decor, right? Now, extract from the consolidated, don't forget, financial statement of Magnolia Group for the year ended 31st December X6 and X7. This is X6 and this is X7. Now wait, can you see the sales drop? Can you see the sales drop? Sales drop. Last year this was the sale and this year this is the sale. Okay, so there is a sales drop. You can see 145,900 minus 114,800. There is a sales drop, and the obvious reason for this sales drop is the disposal of this subsidiary, because in 2006 you have this subsidiary, the name of Pearl. 2006, in 2006 consolidated results, 2006 consolidated reserve, you had Pearl with you. But now in this year 2007, very first day the Pearl gone, the Pearl company gone. So in 2007 there is no addition of Pearl results. That's why the sales is down. Okay, and if you are a kid and if you like sketches, see these sketch. See, these are the two accounting period. 1st January X6 and this is 1st of okay, so I'm talking about this year. On this second year, very first day you sold for 52 million. You sold your subsidiary for 52 million. So in this year you have like Pearl results are included. In this last year the Pearl results are included, but in this year there is no result, though no Pearl results are included. Why? Because the very first day you sold your company, you sold this company. Okay, so a lot of interesting facts are left. Let's do it now. So you have a little income statement extract with you. You have inventories, cash. Now see, there is an increase in cash balance. There is an increase in cash balance by almost 20,000, by almost 20,000. Okay, so you know what is the reason of this cash increase? Listen, because you receive 52 million, you receive 52 million means 52,000 cash from the sale of subsidiary, but there is a cash increase of only 20,000. that means you used some of the cash for repaying your loan. You use some of the cash for repaying loan. So see your loan, see your non-current liabilities are down. See your non-current liabilities are down. Please think over it. Please think over it. Your non-current liabilities are down, right? Okay, so you use some of the loans to repay, so use some of the cash to repay your loan. Okay, this is one of the use which you need to highlight. Now, the accounting manager, see this is the note number one. Note number one. The accounting manager did not account for Pearl as a discontinued operation. Wrong accounting. See, if you sell your, first of all, wait. If you remember IFRS 5, if you remember IFRS 5, NCA held for sale and discontinued operation. NCA held for sale and discontinued operation. If you remember IFRS 5, so for discontinued operation accounting, your operation must be a separate major line of business. And yes, home decor is a separate major, is a separate line of business, so it should qualify as a discontinued operation. Also it's a separate component of entity. Component of an entity means whose revenues and cash flows are separately, whose revenues and cash flows can be separately accounted for. And yes, the revenues and cash flows, the revenues and cash flows of this subsidiary can be separately accounted for. That's why results are separate. Results are also given. Okay, so yes, it should be accounted for as a discontinued operation. Now, but as a student you may ask one question. Sir, listen, sir, when we sold this on the very first day, that means there is no earnings. There is no earnings in 2007 for this Pearl company. For us there is no earnings. Yes, I agree, there is no sales, cost of sales, which we can write separately in a discontinued operation column. But when you sold it on the very first day, whenever you sell a subsidiary, remember your accounting, it's revision days. When you sell a running business, you dispose of a subsidiary, you get gain or loss on disposal. Yes, so that gain or loss on disposal, that gain or loss on disposal, that gain or loss on disposal will go, that gain or loss on disposal will go in discontinued operation column, so it will be a discontinued operation. Okay, and one very good thing, if you remember, so this year you will write in discontinued operation, discontinued operation, that gain or loss which you got from this disposal, plus if you remember the accounting, listen, if you remember the accounting, if this year you are doing discontinued operation accounting, then in the comparative, if you are preparing comparatives of last year with this, if you are doing discontinued operation for Pearl, if you are doing discontinued operation accounting this year, then in the comparatives of last year, you must do discontinued operation. Pearl must be reported as a discontinued operation. Okay, so this theory you must write if this examiner will ask. Okay, now read this. The accounting manager did not account for Pearl as a discontinued because the disposal occurred on 1st January X7. That's the wrong treatment. As the division was sold, so no information for Pearl company has been included in the 2007 financial extracts above. Yes, this is correct. It is sold on 1st January, so nothing sales, cost of sale, you can't add anything. Okay, and also if you follow discontinued accounting, it will go in a separate column down at the downside of the income statement, not at the front line. The proceeds from the disposal have been received in cash. Very good. While all the net assets and goodwill have been derecognized. Perfect. The accounting team is confused about the accounting treatment of the balancing figure. Yes, that is gain or loss. That is gain or loss. Hope you remember the lectures, that whenever you sell a running business, you receive cash. Yes, you dispose of net assets of S company, you dispose of the goodwill, and the balancing figure will be your gain or loss on disposal. So if you read these two lines, if you read these last two lines, you will easily, my dear student, grow up now, you will easily recognize that gain or loss on disposal is missing, and that thing I will do it, don't worry. And but don't forget that gain or loss will go in the discontinued operation column, not on the front line of the income statement. Mongolia company, Mongolia Magnolia company acquired 100% of Pearl company on announced. They are telling you the history because you need to calculate goodwill. They are telling you the history. Magnolia company acquired 100% of Pearl company on 1st January X1, like 7 years back, and which resulted in goodwill of 8 million. Okay, the goodwill has been impaired by 30%. So that means out of this 8 million, 30%, that is 2.4, is impaired. So right now we have goodwill at disposal date is only 5.6. Goodwill at disposal date is only 5.6 million. Goodwill at disposal date is only 5.6 million. Don't forget this. Now the net assets at 1st January X7 is 40 million. Again, important information to calculate gain or loss on disposal. To calculate gain or loss on disposal. Now these are the separate results of Pearl. It will help you out. See, in 2006 these are the separate sales, cost of sales, and profit from operation, that is PBIT, profit before interest and tax. These are the separate profits for profits, revenues, and all for Pearl. Why they are giving you this? They are giving you this because you can do a very good commentary. Then you can better analyze the performance very easily. The Magnolia Group has moved. Now see this, these things you can connect in the commentary as well. The Magnolia Group have moved its accessories division to a building owned by the group, but see, accessories group is still with us. Accessories, we just sold the home decor. I repeat, the Pearl company was involved in home decor, and that's we disposed of, but still we have the business of accessories. See, so the Magnolia Group has moved its accessories division to a building owned by the group, but before the disposal, this building was in use by Pearl. Previously, the accessories division used external facilities on the lease of 3 million per annum. So this will be your saving. This will be your saving. This is saving. See, before this thing, before the use of our own building, we have taken a building on rent for our accessories, but now our Pearl building is empty. Pearl building is empty because it's our own building, and we sold the business without that building. So our building is with us. So now we are using our own building for accessories section, and we'll save this rent, this 3 million per year rent. This is a good saving, but yes, there will be a little penalty. Hope you remember this word, early redemption penalty or early termination penalty. If you cancel a lease contract, if you cancel a rental agreement of long term, then sometimes the lessor applies penalty on you. So next paragraph, get ready for this penalty. As at 1st January X7, the Magnolia Group terminated the lease. Yes, they said we don't want the rental building now because we have our own building, with one-off payment of 4 million. See, this is the one-off penalty of 4 million to lessor, and this payment was recorded in operating expenses. Correct treatment. On 1st January X7, the lease is still has 8 years remaining. Okay, so let's do some what we call it cost benefit analysis. The per year, see this, the per year rent is 3 million, the per year rent is 3 million. So 3 million multiplied by 8 years, we have to pay this rent for next 8 years, it's going to be 24 million. So we have first option is to pay 24 million dollars rent in 8 years, or the second option is to bear this 4 million penalty one time. So it's better you bear a 4 million penalty, because 4 million cost is better than 24 million. But yes, one thing, there is one more aspect which we can write in the conclusion, and I'll show you that now we are using our own building, we are using our own building for accessory sector, so no more rent. But just think about the opportunity cost, just think about the opportunity cost. What is the opportunity cost? The building which we are using right now for accessories, we can give that building on rent also. So that rental income will be our opportunity cost, you can write that also. Okay, but right now this thing is beneficial for us, that instead of 24 million rentals in next 8 years, just pay 4 million and say goodbye to the lessor. And one more plus point I can tell you, see, this is how you do commentary, this is how you extract points from the passage. You think about it, be a businessman, you know, taking something on rent, using a building on rent is very dangerous, because rental expense is a fixed cost, we all know. Rent is a fixed cost, and fixed cost increases the risk of owner. We all have seen COVID, remember? So it's very, very dangerous to keep a fixed cost with us. So this is a good news, this is a positive sign for the company, that company is no more under the threat of fixed cost. The Magnolia Group imports raw materials from overseas. Foreign exchange gains of 3.5 million were recorded in 2006, while the foreign exchange loss of 2 million made in 2007. So these are one-off things. See, foreign exchange things, currency normally fluctuates, so it's a one-off thing, uncontrollable thing. Okay, so if I let's think over it. That means in the last year it was a gain, exchange gain. On this year it's a loss. So just because of this abnormal event, our current year operating expenses will be high. So it's a one-off thing. But yes, this line indicates that this company is exposed, this group is exposed to foreign exchange risk. Foreign exchange risk, this point you have to write. These were recognized within operating expenses. See, so let me see. Last year operating expenses was 45,600. This year it's down. So why this year it is down? First of all, because there is no pearl with us. There is no pearl with us. That's why it is down. Plus this time we have already faced some foreign exchange losses. So it should go up, but still it is down. So it's better. That means the company's operating expenses are in control. Operating expenses are in control. Okay. Now I would give you 1 minute. Kindly read it, and then I'll go to the requirements. Requirements are easy, straightforward. You will understand the question very well. Calculate the gain on the disposal of Pearl Company that would be included in the consolidated statement of profit and loss for the year ended 31st December 07. Let me write something. These are free marks. These are free, honestly free marks. Let me calculate. Gain or loss on disposal is very easy. You remember the disposal proceed. Wait. First of all, disposal proceed is 52 million less as you sold the running business. So net assets, whenever you sold any business, you sold basically net assets. You remember the disposal topic? At disposal date, and you know there is a 100% holding, 100%. Okay, so this is also 100%, so this will also be 100%. Now let's calculate goodwill. For goodwill we have to do COI is how much? Previously when parent company bought this, see this, when parent company bought its COI is 8 million. Okay, sorry, they are giving you ready-made goodwill. So our goodwill was 8 million and it is impaired by 30%. So your original goodwill, आप ले लो चाहिए, मैं नहीं अभी, your original goodwill was 8 million. Okay, less impairment. How much is the impairment? Is 30%. Impairment is 30%, so it's going to be 2.4 million impairment. So how much goodwill after impairment is left? How much goodwill after impairment is left? Tell me. It's 5.6 million. Okay, and this goodwill after impairment is the goodwill at disposal date. So this is a big tip I am giving you. Listen, whenever you need to calculate gain or loss on disposal of the company, you need to use data. Listen, you need to use data at disposal date. All data must be at disposal date. So can you tell me, when you sell running business, you sell goodwill as well. So goodwill at disposal date is 5.6 million. Okay, so finally you can calculate gain or loss. Let me change the color. Gain on disposal, it's going to be 12 minus 5.6. Wait, 6.4 million, or you call it, if the question is in with 3 zeros, so 6400. You can call it 6400. You can write 6400. Gain on disposal is 6400. This is your first answer. Okay, so a free 2 marks. If somebody tells me, sir, make the entry of this disposal, very easy. This is the entry. See, bank or cash debit, 52 million is 52,000. S company's net asset, this is the entry of breaking building. You remember the consolidation building is going to break. So S company's net assets is 40,000. 40 million means 40,000. Bye bye. Goodwill 5,600. Bye bye. So automatically the gain on disposal will come on the credit side. Remember this thing. This will come on the credit side. And how much is this? It is 6,400. Yes. So this is the entry. Entry is not required. Just, there are few students, they love double entry. That's why I made it. There are few students, they like double entry. That's why I made it. Now, the next requirement, explain. Only explain. You don't need to do any calculation. Only explain, please. Whether the disposal of pearl is likely to constitute a discount. Yes. I have already discussed this part and detailed the correct accounting treatment. Okay, I'll tell you. Yes, it should, the gain on disposal will go in a separate line beneath your income statement, below your income statement, right? And then in the last year, in the comparative year, you need to write pearl as a discontinued operation, but you just need to explain. No need to do calculation. Okay, it's just always read the requirement carefully. So whatever I told you, it is written here. Just read it. Just read it. I have explained you, already explained you. See, as per IFRS 5, yes, for discontinued operation, the name of the standard is IFRS 5. Yes, Pearl Company meets the criteria of separate major line of operations. Yes, it's a separate major line of operation, home decor, that was sold during the year. Yes, the result should be removed as a discontinued operation and shown separately on the face of profit and loss statement along with 6.4 million 6400. Remember, gain on disposal. Since Pearl was sold on 1st January X7, the results for the current year are not included in the financial statement. Obviously, very first day you sold it, the very first day, I would say very first day you sold this subsidiary. So you will not do any adding together, or you will not record any sales, cost of sale or anything in the current year. That's perfect. And this, but for comparative analysis, the results of 2006 ought to be indicated as discontinued operation. Yes, if you are reporting if you are reporting comparatives, that means with 2007, if you are showing 2006 results to shareholder, then this pearl should report as a discontinued operation in 2006 as well. You better know if you have done this IS, and I taught this in class. It's all these things are included in my lectures. So this is a 3-mark thing. This is a 3-mark thing. Both of things are normal. Both of things are normal. Now the next requirement is again solid free marks. I would use the word solid, free marks. Enjoy. See this. They are saying, just see, calculate the following ratios and show the workings of Magnolia Group for 2007 and 6. See, GP margin, operating margin, four ratios. See, these 4 ratios we need to do. So very easy. I would say do it yourself. Do it yourself. Let me show you the screen. You have to use the consolidated statement. Okay, this is your statement. Wait. Let me show you. This is the statement. Can you take the picture of this? Can you take the picture of this? Because now I'll move the screen. I've also taken the picture. So I will move the screen. See the screen. Okay, I'm moving the screen now. So the first ratio, requirement C, okay, so the first thing is GP margin, and that is GP upon sales. Okay, so what is your gross profit for 2007 is 52,400 divided by 114,800. You can see into 100. So this will be 45.6%. Okay, now if you do for the 2006, listen, it's 60,200. You have the question. Even you can do it yourself. That's nothing. Pause the screen and do it yourself. You guys are no more infants. 60,200 then you have operating margin, operating profit margin, which says PBIT or operating profit divided by sales into 100. So now what is the operating profit? It's 16,900. Go and check for 2007. I'm saying divide by 114. Sales is 114,800 into 100, which is equal to 14.7%. Then next year you have 146,000, 145,900 into 100. It's exactly almost 10% or 10.1%. Then you have interest cover. Hope you remember the formula of interest cover. It's PBIT upon interest expense. PBIT means operating profit. Okay, so operating profit is 16,900 divided by what is interest expense, 4,300. So this is going to be 3.93 times. Okay, then you have operating profit for 2006 is 14,600 divided by interest expense is 7,500. So this is going to be 1.94 times. Then last but not least, inventory days. So closing stock divided by cost of sales, okay, into 365. So closing stock is, see the stock, closing stock is 15,400 for 2007 divided by cost of sales is 62,400 multiply by 365 because we need answer in days. We need answer in days. These are basic things, please. These are basic things. These are basic things. It's 90 days. Then you have this year, you have 26,800 is your inventory, closing inventory. Your cost of sales is 85,700 into 365. Now this is 114 days. My dear student, you got 4 marks. You got 4 cash marks for this. And this is, again, I would say these are passing marks. These are, if you miss these marks, then we can't do anything. These are passing marks. Honestly, these are passing marks. Okay, now the last part, the last and the most interesting part is about the commentary thing. Let's read the requirement. Analyze the performance and position. There are some performance ratios like profitability ratios and positions which are related to SOFP of the Magnolia Group for the year ended 31st December X7 compared to the year ended 31st December X6. Okay, so now listen very carefully. The next 15 minutes, the last 15 minutes are important for you guys. Listen, first thing first. First of all, in 2006 your GP margin was 41.3%. now it's 45.6%. so your GP margin increased. Listen, just think over it. I'll give you a connection. Although your sales went down, but still your GP margin went up. Now what may be the reason? Last year result, there was a subsidiary results were added. What was the name of that subsidiary? Pearl. In last year results, Pearl was added. But there is no Pearl. In this year. So this means that because of that Pearl, last year GP margin was low because we were showing the combined result. Because of that Pearl. Everything was down. Okay, and when the Pearl left, in 2007, our results improved. I can give you one evidence for that. Let's go to the separate financial statement of Pearl and let's see how much was the GP margin of Pearl separately last year and this year. See, this is the separate, see, Pearl's individual. So this is GP upon sales. So 14,800 divided by 42,200 in 200. 14 14,800 divided by 42,200, 35%. See, now you have evidence. That means last year individual GP margin was 35%. And if you club it with us, so our GP margin was for 41.3. I repeat, the separate GP margin of Pearl was 35%, but when we combined it with the parent company and the other subsidiaries, it is 41.3%. So that means the overall GP margin of parent and subsidiaries other than Pearl was better, and this year is the evidence. This year is the evidence. Okay, so the Pearl was the bad company with us comparatively. Pearl was not as good as the other subsidiaries and parent company. That's why last year GP margin was low and this year it is improved. One more thing. See, the sales went down. The sales went down. Last year sales was 145,900. Let me show you. Last year, please students, last year sales was 145,900 and this year 114,800. Okay, but you as a student you will say, sir, this comparison is not like with like. I said, okay, I agree, this comparison is not like with like. This comparison is not like with like, because in the last year income statement Pearl sales was also included. This year, in this 2007, there is no Pearl included. There is no Pearl included. So sir, in last year income statement Pearl sales was also included. So let's do, from to make the comparison like with like, to make the comparison like with like, let's remove the sales of Pearl from this 2006. See, what was the sale of Pearl in 2006? It's 42,200. It's 42,200. See the screen. So let me subtract. Wait. Minus 42,200. So it will be, wait, 145. So now see, 103, see 700. So now that's the better picture. See, so without Pearl last year sales was 103,700 and now this year is 114,800. So there is an increase of 11,000 almost. Yes. If you just simply ignore the Pearl, still there is an increase in sales of 11,000, which is a positive sign. So that means the all other functions of group other than Pearl was doing excellent, was doing good. Okay. So 2 points I have highlighted. 1 point regarding GP margin I have highlighted. The other point, please don't sleep next 15 minutes or 12 minutes. And the other point regarding sales. Now, can you see the operating expenses? Last year operating expenses was 45,600. This year 35,500. Although it is decreased, and it is decreased because one company left us. Okay. Now, see the operating. Wait. Operating margin was 10% last year. This year it is 14.7%. This is a good sign. So it means our operating expenses are in control. And one reason is that our sales went down. See, last year sale was 145,900 and this year is 114,800. So when denominator goes down, your final answer goes up. Okay, so one reason for this increase in operating margin, increase in operating margin is decrease in sales. And the other reason is your operating profit also went up. See, your operating profit also, the numerator also went up. And should I tell you one more thing? This thing I have taught many times in last 6-7 years, many times, honestly. See, GP margin also increased. So we call it one thing, we call it carried forward effect. Whenever GP is good, the effect comes to NP, operating profit as well. So there is a carried forward effect of GP margin on operating margin. Now, few things which you should discuss. Listen. One thing is, last year there was a foreign exchange gain, and this year there is a foreign exchange loss. So because of that loss became the part of operating expenses. So this year in 2007 your operating expenses are exceptionally high, but still your operating margin is good. So if you remove that one-off event, so it will be much better. If you remove that foreign exchange loss from operating expenses, it will be much better. So that means it's a positive sign for company. But yes, one more thing you will write, that company is exposed to foreign exchange risk. Company is exposed to foreign exchange risk. foreign exchange risk. Okay, right? Company is exposed to foreign exchange risk. One more thing which I would tell you. You remember we cancelled one lease. We cancelled one lease which was remaining 8 years was left, but we cancelled it. So that penalty we also put in operating expenses. So because of that 4 million extra penalty this year because of that 4 million extra penalty in 2007, the operating expenses of 2007 are exceptionally high. That's why your operating margin is only 14.7%. Just think, if there would be no penalty, if there would be no such penalty, we would be much better. We are still better, but we would be much better. Just think over it. Okay, so all these points you need to highlight. I'll show you how to write it. Don't worry about it. Don't worry about it. Okay, let me show you. I've written very easy pointers for you in easy language. Just it's everything in all your. See, total revenue. First of all, if you see the income statement, there is a drop in revenue. Okay, this happened because Pearl was sold. Yes, Pearl was sold. Pearl was sold. But if you want to do comparison like with like, the actual sales revenue grew by 11.1 million. I showed you, just showed you. If you remove Pearl from last year, there's in reality there is an increase in revenue. I showed you just right now. Then see this thing. Pearl's company revenue is 42.2 million. You can read all these three lines. Gross margin now 41% to 46%. Pearl company had a lower margin of 35%. So removing it, saying bye bye to Pearl, saying goodbye to Pearl, improve the overall margin of the group. Improve the overall margin of the group. Overall margin of the group. Operating profit margin improved even though revenue fell. Or even though revenue fell. Yes, I told you this. This is because operating expenses also dropped by 10.1 million, we just discussed. And why operating expenses decreased? Because there is no Pearl with us. So this is one of the reason. Then you have to discuss the one-time lease exit payment, this 4 million. But yes, in reality there is a cost benefit analysis, because we just took one time hit of 4 million. But if we would continue that lease, it will cost us 3 million per annum. 3 million per annum. Go and see the question. 3 million multiplied by 8 years, it's 24 million. So it's better to bear 4 million penalty rather than 24 million, right? In 2006, there was a foreign exchange gain of 3.5 million, but in 2000 loss. See, this year there is a loss. This shows company is exposed to foreign currency risk. And one more extra point which you can add is that with the loss of 2 million, still our operating profit margin increase. If there would be no loss, we would be much better. Okay, just one line you can also add. I'm telling you. Now interest cover you can see previously interest cover was 1.494 times, now 3.93 times. Let me tell you the definition of interest cover. The definition of interest cover is, listen, interest cover shows the interest paying ability of the company. So now we have good interest paying ability. And now if you see, the formula is PBIT upon interest expense. So why your interest cover is going up? Because your numerator is increasing, your profitability is going up, and your interest expense is going down. So when numerator is up, the final answer is up, and when denominator is going down, the final answer goes up. So numerator and denominator both are in our favor. Numerator and denominator both are in our favor. Both are in our favor. Numerator and denominator both are in our favor. And one more thing, sir, why in the denominator you have to write the interest expense? So why your interest expense is going down? Why your interest expense is going down? Should I connect? Because your non-current liabilities are going down. Check it out. See, your non-current liabilities are going down. See this. Your non-current liabilities are going down from 75,500 to 53,200. And now the next question, why are non-current liabilities are going down? Two reasons. Two reasons. First, we cancelled the long-term lease of 8 years. We cancelled the long-term lease of 8 years. So that's why your non-current liability is going down. And the second reason may be we repaid some of our loan because we got big cash. We got big cash from the disposal of subsidiary and we repaid some loan. So that's why when you repay your loan, when your loan goes down, so your interest expense goes down. So this connection you should discuss with the examiner. See this. Interest cover increased from 1.23. This is because higher operating profit and lower finance cost, partly due to the ending of lease and repayment of loan, which we can see from question. From SOFP it is written. Okay, now the next ratio is financial position. In financial position, see, non-current liabilities decrease likely because I just showed you the non-current liabilities from 75,000 to 57,000 something. The company removed the lease liability from accessories division, 8 years remaining. See, we just cancelled the long-term lease agreement. That's why our liability is going down. One reason. Part of the money from selling the Pearl 52 million was used to pay some of long-term debts. This may be the reason. Yes, we allocated our funds in such a way. And yes, your cash balance went up by 20.8 million. So the rest was likely to reduce liabilities. See this. Wait. Please. Relax. See this. Yes. Open your eyes and see this. Here, there is an increase in cash balance by almost 20 million or 20,000. There is an increase in cash balance by almost 20 million. But in reality, we received 52 million cash. In reality, we received 52 million cash from the sale of subsidiary. But the cash balance is only increased by 20 million or 20,000. So where the remaining 32 million went, where the remaining 32, it is a major part is used to repay the loan. A major part of that is used to repay the loan. Okay, that's why your loan non-current liabilities are going down. That's why your non-current liabilities are going down. Okay, are you getting? Then can you see the inventory days? Yes, inventory turnover days was previously 114 days. Now it's 90 days. Previously 114 days, now it's going to be 90 days, which is good. Now you will keep your inventory less days, but this whole discussion is not that much relevant. Why? Because listen to me, your company, this group is not dealing with perishable goods. So as these goods are not perishable, so 90 days is still good. 90 days is still good. Had these goods been perishable goods, then we should worry about it. Otherwise, it's very normal. One more thing, we can say that we said goodbye to the Pearl, and after saying goodbye, now our inventory days gone down. So that means there is a possibility. Listen, there is a possibility that inventory days of home decor, that was home decor business. Home decor business was high, and the accessories business has got comparatively low inventory days, which is a good sign, which is a good sign. See, Pearl company had large, which we, okay, inventory turnover has improved. You call it days or you just say inventory turnover. These are two opposite words. One thing is inventory days and the other thing is inventory turnover, which we express in times. Okay, so if you let's talk about the inventory days. Yes, it is improved, because from 114 days to 90 days, this is called improvement. When your inventory days going down, it's improvement. Okay, has improved, meaning the company is selling inventory faster, yes, than before, for sure. Inventory days are still high, yes, still 90 days is not a small number, but the company sells non-perishable goods, so it's not a big problem. I already told you. So one lesson you just learned: see, don't solve ratio question like a dumb student. Try to see the industry. Try to see the industry and try connection. Do connection. See, I've connected. I have connected. Are you getting? You need to connect the links. You need to connect the dots. Not getting? You need to check which industry you are in right now. If there is a food industry question, then definitely these food is a perishable item. Removing pearls seems to have fashion and help fashion and accessories. Yes, better in inventory compared to home decor. I have already told you that previously the inventory days combined was higher. Now it's lower because the pearl has gone. That means pearl in pearl group, in the pearl company, the inventory management was now not that good, but now it has improved. It is improved. Without pearl, we are better. Now finally the conclusion. Although pearl was making profits, selling it was a smart decision. Now wait, let me tell you two things. See, we have just seen the comparison that after saying bye bye to pearl, our results improved. So for us it is good. Number one. Number two, pearl was already in profit, so it's better to sell your companies in good times. Just think, if the ship is sinking and if it is sunk, the end, now nobody will buy. Nobody will buy. You have seen the history of Yahoo. You have seen the history of Yahoo. Okay? In the end, they sold it for less than $5 billion. And there was a time they were getting offers of hundreds of billions of dollars or $50 billion, but they were very arrogant. So always sell your business when it is performing good. If it is gone down, nobody will buy it. Nobody will buy it. Common sense. Common sense. Okay. Pearl company is doing even better after the sale, showing it was not sold because of poor performance. Okay. You can see the individual results next year. It's good. Accessories division now uses the company's own property. See, now you remember the own property. So it save money on rent. However, I have discussed this. The company no longer earns the rent from that property, which is opportunity cost, I hope your mind is working. Overall, focusing on the remaining division has improved profits and the future of. Let me explain this last point. I hope you have heard about Steve Jobs, the old CEO, very famous CEO of Apple company. And if you read his story, his history, before 1996, he left Apple company. And then when he joined Apple company, he closed many irrelevant segments of Apple company, and he focused on like only PC manufacturing, the main PC and the phone manufacturing. That's the Apple main product. He said we'll focus on our main activity and we'll close all irrelevant activity. And after that, Apple company went like this up. Okay, so sometimes if you are involved in many things, that does not give you focus. And this goes with your life as well. Okay, there are students, they do at the same time, they do ACCA, they do BBA, they are doing in 3-4 qualification. That's not good. First try one qualification and complete it. So it's better we have shrinked our business and now we are focusing on our business and see our results improved. Okay, so now in the end, I would say that there are different angles of doing commentary. Even you can do more commentary than this. Okay, you can think about more points than this. Okay, so finally, best of luck for your exams. Try to make your study plan and be focused. Don't waste your time on social media and all stuff. Okay, be careful. Best of luck. Take care.